How should you be trading the gold and equities markets right now? Bill Baruch, president of Blue Line Futures, is back to talk about trades and what to look out for in the economy. Bill, welcome back.
Thank you for having me on again.
I have to congratulate you because last time we spoke in October, you had said that equities would go up after the election and that gold would be held in a range and not touch the 1900 to 1950 level. Those were the right calls.
Because I think coming out of the election, we're going to see the market move higher, and we're going to see move higher into at least the very start of quarter one. I'm prepared to not see gold above 1950 through the election, and really I'm prepared to not see gold above 1950, 1970 until the second half of December.
So my first question is, can I borrow your crystal ball that you have somewhere in your closet? But no, on a serious note, how do you feel now? Because gold hasn't just traded range bound; it's kind of gone down. So would you be buying on the dips right now?
Yeah, gold had a pretty bad start to the week, broke through what we call rare major four-star support, 1845, 1850. I like using this sell-off as a reason to position for the longer term, but very slowly. You got to be patient. And we started stepping in again here with micros. You can really customize your size and build a position with those for smaller accounts too, in near that 1800 mark. Ultimately, though, we've started to see this selling come in as the managed money net long position fell by nearly 60% from its peak in August. And that happened over the last couple of months and really saw some selling here through the last few weeks. That means that the sellers have already started to sell. And this is that washout. I'm really curious to see, because this Tuesday will be on this Friday's Commitment of Traders report. So I'm really curious to see where we are after that and where the positioning is. And ultimately, I like to see a washout. I like to see a cleansing. We have the December contract expiration. The options are expiring on Tuesday today, and then the futures are expiring later this week. This is a cleansing. This helps rebalance the market profile. And all of this is happening right ahead of a very seasonally bullish time of year. So I didn't want to be buying and chasing gold ahead of the election or really right after the election, because I want to be patient and build this long, use this sell-off to build a long position going into the second half of December and through quarter one.
This is a pattern we've seen in the last two election cycles, right? 2012, 2016, both times gold sold off for a month after the election results came in, and the dollar strengthened in 2016, as you know. We're seeing a similar pattern here. What's going on? Is it just a repeat? Is this a coincidence? What's happening here?
Well, gold gets a bid with uncertainty. And so we noticed this trend in the past. I may have mentioned it to you in the previous interview too, but one of the reasons prior in 2016 was the dollar surged up to really the highest level it's been in many years after President Trump's election. Now, this isn't the dollar rally as much, although the dollar has not broken, the dollar index has not broken really through that 92 mark, and it really can. And that could be what stops gold from selling off. But this a lot of happened to coincide with vaccine news. So you have less uncertainty after the election, and now you have the vaccine news bringing a tailwind to risk assets, but also sucking out some of the hope that the Fed will have to do more. Ultimately, it's saying the Fed will have to do less. But I think that narrative is really getting ahead of itself because there's still a lot of uncertainty out there. Distribution of the vaccine, when is it going to take effect? But more importantly, what's the damage that's going to be left behind from these lockdowns, from this year-long shutdown of the economy in different areas? So I think that's going to be bullish for gold long term. And then remember, the Fed said they're going to let the economy run hot. They're going to let inflation run symmetrically out above their 2% target. And right now, they're not predicting to raise interest rates until well into 2022, really 2023. Although I do think that moves up a little bit.
Okay, let's talk about yields in a minute. But first, let's do our speed round. I'm going to give you a few asset classes for sectors. Just say whether or not you'd be long or short or neutral right now, given where we are in terms of prices. So the first one is gold. You've talked a little bit about that, but would you be long or short at these prices?
I like patiently building positions. One of the things that we're looking at is using the micros. And if we're managing a $100,000 account, to start positioning so you don't have to pick an exact spot. And you get 10 micros on, that's one large 100-ounce gold contract, and you can do that patiently. So we like buying into 1800. We do think it's going to rebound in the coming weeks and months. So this is a good area to patiently position.
Tech stocks.
I love software. I think if anything's going to be double from here, it's going to be software over the next 5 years. I think that's going to be really great. I think we're seeing inflation within the space. I think software is going to be an integral part. And a lot of companies that rely on software, they're not going to cut their relationships in times of and poor times. Otherwise, they're really going out of business. So I think there's a lot of great software companies out there. Salesforce, Microsoft, really some obviously the big names. love software and technology. So, you got to have that as a staple in the portfolio, although it may not be the best performing sector here over the next few months.
Consumer discretionary stocks.
Those are great stocks. I think ultimately you need to have some positioning in there. It's a tough one. A lot of them have run quite a bit, and I think we're starting to see this consumer discretionary stocks. I'm not overweight on those, although if you've been riding those, I mean, there's no reason to be selling. The path of least resistance remains higher.
Yeah, consumer staples.
Those two, I think along the same lines, I think the Targets and the Walmarts, so those have done extremely, extremely well. But again, I wouldn't be chasing those names out above here. I think there's better value elsewhere, although those names should continue to perform.
Industrials?
I love industrials. That is where we've been overweight coming in to the election, really through October, doubling our positioning in the industrial sector. And I think the industrial sector is a place that will continue to rally. We've seen some really great names move very well, Boeing being one. But ultimately, some really great balance sheets out there through that space. I think that's going to carry it through 2021. And the Dow is just breaking out at that over 30,000.
You have called higher prices following the election, but is now the time for a reversal, Bill, you think?
I think we're going higher. I don't see a reason why this market's going to slow down. This is a very, very seasonally bullish time of the year, Thanksgiving into the first half of December. So you don't want to get in the way of it. And it's a lot that's lining up right now. Less uncertainty after the election. We're starting to see signs of a better transition of power from Trump to Biden. The market likes that. There's also more certainties coming with new Treasury Secretary, former Fed Chair Janet Yellen now being the Treasury Secretary. Sorry, that little tongue twister there. But the market knows what her policies have been in the past, and that's more certainty. The market is feeding off of that.
So if I were to implement a pair trade, let's say I were to long the Dow and short gold short term, would you agree with me or disagree on that?
I wouldn't disagree, but I think it's too late to put a position on like that. In the sense of that there's gonna be a lot of people out there that say gold's dropping, gold could go to 1,700 to much lower. But I think ultimately that's a very, very tough one to look at, because I think that if for some reason there was reversal in equity markets and gold found footing, I think we're starting to see gold decouple from equities. I just don't like that pair trade at all, really. I'd stay away from it because the Dow could run higher, gold may not perform, but I just don't feel comfortable with it.
All right, you did talk about the seasonality aspect of gold. And so let's say going into 2021, I think last time we spoke, you had said that $2,300 by the end of Q1 is possible. Do you still maintain that call?
Yeah, I do think it's very possible. I think if the technicals on the weekly basis have lined up fairly well, although this week is looking pretty ugly. I think 2,300 is ultimately in the cards. It may not be something that happens very, very quickly in the start of the year. I mean, for instance, if we had held 1855, I think 2,000 would have been regained very, very quickly. The fact that we've now gone below 1855, I think to predict the timeline and seeing something like 2,300 or move back above 2,000, we really need to see how this damage is repaired. That's what I'm waiting to see. How is this damage repaired this week in gold? And then when can we close back above 1850? And that's really going to set things in motion.
Yeah, because I heard that, we've broken support levels. So this might be the start of a new bear trend. What's the support level for you?
Well, 1845, 1850 was a rare major 4-star support. I write every day about gold. And one of the things I've been talking about over the last week and a half, 2 weeks, was we were seeing the 8th, 9th, 10th, 11th test of support. And I pointed out, how many times have you seen a support or resistance level, for that matter, get tested that many times and not break? So we were really expecting some sort of break here. We didn't know how bad it would be. And right now, I mean, this is to be expected. It's held fairly well given the pent up selling upon a break. So I want to see if we can hold ground at 1,800, get through this options expiration, get through the December futures expiration, and then can we start beginning some repair? The repair is what's going to matter. When can we close back above 1850 now? When can we close back above that previous support and then start moving up? So that's what I'm waiting to see to really give me more of a landscape on or a timeline on when gold should regain $2,000.
At what point would you feel uncomfortable about gold prices? At what point would you say, okay, we've really just, this is not a good trend that we're seeing right now, and maybe there are other macro factors that are coming into the economy, coming into the headlines that are going to keep driving this lower. At what point would that happen?
Well, on a technical basis, a weekly close below 1760. I think that would really open the door for continued selling. On a fundamental basis, obviously, the Fed moving their timeline to hiking rates somewhere, I don't think that's possible 2021, but yeah, the first half of 2022, that would really keep gold under wraps. The dollar index reversing from 92 and gaining strength, that would be a headwind for gold. And then really successful distribution of the vaccine, which is great for the culture, great for the country, great for the world. And seeing that's going to really matter. And how does this vaccine get out? Because that's ultimately going to give you a timeline too, to start to see some construction. But really what it comes down to more than anything is what's the damage in the economy that's left? We've seen some really good manufacturing, some really good services PMI data. But what about the small businesses? And there's a lot of questionable damage out there that we could see, and that could really is what's going to keep the Fed at bay and not raising rates, really not projecting to raise rates until at the best back half of 2022.
Yeah, I mean, that's the argument that I heard, the counter argument rather, is that, okay, we've got vaccine news that hurt gold, but why would it hurt gold? The vaccine doesn't erase trillions of dollars of debt. It doesn't erase the monetary stimulus that happened this year. That happened. The money is out there. Money supply is, at record levels. Those are the factors that really drive gold, and they're still there.
Absolutely. They're not going anywhere. But I think as you see gold get hit here, one of the things to remind yourself is some of gold's biggest selling has come on lockdowns due to deflationary fears, and the vaccine through next year is going to really kind of dissipate those deflationary fears, and we should start to see inflation, and that should be a tailwind for gold, if anything. So once you kind of work through this initial reaction due to the vaccine, I think we'll find gold using it as a supportive narrative too.
Yeah. So final message on sentiment, Bill, going into Q1 2021, more risk on, more risk off. What do you think?
Yeah, I think risk on. I think we got a coast is clear, green light for equity markets. The Russell 2000 small caps, they're breaking out. They broke out yesterday. The Dow, that's breaking out here today. The S&P, it's almost at its record high. For all intents and purposes, it's already broken out. The Nasdaq starting to see some good movement here today, Tuesday, and moving what we call major 3-star resistance, 12,050, 12,075. So we've got a green light in stocks. I think that's great. One of the things that I think that I like going into the first part of next year is seeing rates rise. And that's a trade we've already hit once. I mean, I was last on your show talking about where my big plays going into the fourth quarter was looking for the 10-year yield to rise. And I'm playing short the 10-year futures, which are the prices. And ultimately, we hit that really well, and we're starting to reposition for that. There's some interesting ways to play it. I mean, obviously, you can just go short the futures, but we like taking advantage of volatility. In fact, I have an entire commodity fund focused on volatility. It's fully managed that we launched on November 1st. It's one of the things to kind of look at. And we look at volatility and the fact that there's some really, really cheap volatility out there in the 10-year wings, far out and getting away from at the money strikes. And you can use that to your advantage and position really well. So we're using some option strategies to position in the 10-year puts and take advantage of potential rise in yields because the prices go lower. So that's one of the things we're looking at or in already starting to position in going into the second half of quarter four. And I think that's going to be a narrative, green light for stocks in through start of quarter one. And then treasury yields are going to rise. I think gold's going to start to hold some ground. One thing though that I do want to see and we cannot ignore is it's going to be, I think it's January 5th now is the Georgia election. We do have to see a split Congress. If we see a blue wave, the market's not going to like that. Risk assets are not going to like that. Although gold is going to like that. Gold's really going to like the fact that you're going to see much more money printed, but it could definitely bring some headwinds to tech and other parts of the market. So that could be more of a big uncertainty. The markets hate uncertainty going into January 5th. You could see a little de-risking ahead of that. And that also aligns with the end of the year. The last week of the year has actually been not favorable for the stock market. So you get this Christmas rally, but Christmas itself is not favorable. So keep that in mind if you're trading.
All right, Bill. Excellent thoughts today as always. Thank you for coming on the show.
Thank you very much for having me. Looking forward to joining you again soon.